what should we expect from this week's Treasury auctions and from the Fed as it weighs its next actions? Joining us now, Derek Brown. Derek is Director of Fixed Income at Transamerica Investment Management. They have $14 billion in assets under management, and almost $7 billion of that is in fixed income. Derek, great to see you. Ask you about the currency reserves here and how that impacts the bond market here in the U.S. in just a moment. But first, let's begin. Let's set the stage. Give us your outlook for Treasuries here ahead of the three-year auction, the rest of the auctions this week. Interest rates, of course, have come up of late. So where does that put you?
Right. So, we think that with the backup in rates recently, the three-year auction should go off pretty well. We've seen the three-year back up about 40 basis points over the past month, and at a 170, looks to be relative value here in the near term. However, on a secular basis, we do look for rates to trend higher here in the U.S. over the next couple of years.
Derek, talk to me about how that's going to be impacted by the supply and demand imbalances.
Sure. Last year, at fiscal year 2009, we got about $1.8 trillion of net new Treasury supply, and that's about 4 times the previous record as was set in 2008. This year, we anticipate at least $1.5 trillion of Treasury supply, and then $1 trillion a year beyond that. We think that with the Fed stepping away from their asset purchases, as you recall, they bought about $1.8 trillion in supposedly risk-free assets over the past year. That the largest buyer of this type of security is stepping away just at the time that we're anticipating much more supply.
So what is your anticipation then with these auctions going out longer maturity? Is there going to be some problem there, especially if you could put into consideration our unprecedented federal budget deficit?
We think so. Despite the fact that the last 10 and 30-year auctions went off pretty well, when you consider the fact that the Treasury wants to extend the average maturity of their debt outstanding, to me that implies that we're going to see more issuance out the curve. And when you think about the objective of the Fed and Treasury here, they're looking to inflate out of a very deep recession. So we think for several reasons that the long end of the curve is a place that's pretty vulnerable right now.
But Derek, as you're no doubt aware, over the last few months, at the very least, we've been getting a lot of mixed data. What position does that put the Fed in? And as we were talking to our economics editor, Michael McKee, before, the language today that we might expect from the minutes, how is that going to impact this?
Right. To address the mixed data first, I think mixed data over the past several months is really the best thing for risk assets like commodities, corporate bonds, equities, et cetera, because
Why do you say that
enables the Fed. It enables the Fed to stay on the sidelines. It gives Bernanke some breathing room, to not have to establish credibility as an inflation fighter. He was able to do that by increasing the discount rate last month, by letting a lot of these temporary liquidity facilities that were put in place in the fourth quarter of 2008 roll off. So the Fed optically can look like they're being vigilant on inflation, but in reality, we think that they're really keeping the pedal to the metal in terms of putting stimulus into the economy.
So, Derek, do you think...
And the mixed data enables them to do that.
Indeed. Do you think that there's some behind doors arguing, fighting at the Fed going on right now? Do you think we'll get some hint of that with the meeting minutes today, given you've got Alan Honig of Kansas City, of course, dissenting? So much talk about this extended periods for rates staying low language and debate about that of recent weeks.
Absolutely. There has been some internal debate with the hawks on the committee, Honig and Ploser specifically, looking to remove the accommodation earlier than the more dovish members of the board like Bernanke and Janet Yellen, who will be vice chair going forward. So I think you'll see some more of this debate come out in the minutes. But our view is that they're not going to remove the extended period language until probably June at the earliest.
Derek, how is that growth in global currency reserves? How is that going to affect the bond market?
Well, clearly that implies that there are many dollars out there that will probably be recycled back into Treasuries. So I think it's a force that is unnaturally keeping rates here in the U.S. too low. The U.S. currency reserves have grown, in my view, due to a number of reasons. But when you look at what happened in Greece over the past couple of months, I think that really gave the Treasury a break because it shifted the focus away from the huge deficits and debt that we're incurring here to problems over in Europe. So I think it makes the dollar more of a solid reserve currency for now.
Yeah.
But we do see the U.S. levering up and that becoming an issue later.
Derek Brown, Director of Fixed Income at Transamerica. Thanks for setting us up ahead of today's auction, where bonds are headed from here.